enjoyed that strategy session and the examples, and hopefully you're excited now. I think at the end of every one of these strategy sessions, you should really be getting revved up to just go and apply yourself into the market. Now, again, what I would say, put the brakes on. Don't develop bad habits early on. Make sure you're completing the templates. Follow the process. My old boss in my first ever job used to have a wonderful expression of, there is always method in the madness of a process. And sometimes we think processes are silly and we don't understand the point of them. But in time, as we grow, I'd like to use the word wiser, we do tend to recognize how important these processes are and why we follow them. That being said, let's follow the process. Let's complete the template together. So obviously, in terms of market context, the initiative to initiative, by the very nature, is trending to trending. We do see obviously the small phases of absorption, from the obviously response as well as the secondary response. I did go through that in quite a great detail. So as you're completing this, again, go run through that process of interaction that you see when seeing this trade strategy. In terms of balanced, imbalanced, you're going to see this in imbalanced markets. Why? Well, simply imbalanced market auction theory suggests that key auction reversals occur when prices are at a discount or at a premium. In terms of trade location, at the extremes, note obviously with the name for this is the V or inverse, the V or inverse V, and the two variations were ultimately the symmetrical V or inverse, as well as the engulfing or outside candles at the extremes. Those are the two variations we discussed. So again, highlight this, in terms of where we're trading, where did it occur, and ultimately you can draw upon that information down the line. In terms of conditioning of the markets, note initiative requires large time frame participants, so we're going to be seeing a lot of them. Because of that, liquidity will be relatively low as we initiate in one direction, and then again low as we initiate in the opposite direction. So just keep that in mind. Obviously, as we do see this initiation, liquidity does tend to be at a premium, hence why we tend to move the way we do. Bear in mind, as I always say, or that I've mentioned a number of times, the degree of how far a market will move is all based on how much liquidity is being provided to those participants. More liquidity, smaller move. Less liquidity, much further a move. Okay, in terms of volatility, it won't be excessive. This is the interesting thing. Most people tend to think it'll be excessive. It won't really be. Simply because it's unusual for markets to do these sorts of, V reversals. Okay, it's very unusual for a market to go straight line up and then straight line down. Okay, I have that expression that I've shared with you earlier on the course. It takes time for a ship to turn, but every now and again that ship turns pretty quickly. And when it does, you have to make sure you've got a rules-based approach or a strategy approach to executing. And if not executing, make sure you're avoiding, losing too much when there is fact-based information in the marketplace. Okay, let's now move on and talk about strategy identification. So the interaction was probably the key to understanding this entire strategy. If you want to get good at the strategy, you're gonna have to be almost like a professional interaction specialist. Just like footballers, you get professional or guys who take the free kicks all the time. It's a similar thing. If you really want to be good at the strategy, you're gonna have to learn to recognize when we have that very aggressive switch in price action from initiative to initiative. Now, note obviously, in terms of the interaction, we do get that initiative until we find that responsive, that first bit of responsive. We then obviously see the opposite side taking initiative, which runs into very, very short-term secondary responsive before seeing the continuation of initiative. We did cover that quite extensively, so again, make sure you build upon that interaction within this template. Do note it is a very aggressive interaction at most parts of the strategy. In terms of obviously, what I've included here is daily continuation requires the following. Now, we spoke a lot about how we can identify, the potential for a trade the following session. Now, bear in mind, there were two strategies, two variations. One is on the first day, and the second was on day 2. And we spoke about, ultimately, in order for there to be continuation on day 2, we require a large relative tail, in other words, a weak close or a strong close. We also require cumulative delta in the direction of the reversal, and then also a high relative daily volume. Okay, so the reason for the high volume obviously was because when we have initiative, it means there's high volume by nature. Therefore, initiative to initiative means there should be a really big amount of volume. Okay, in terms of the metrics, note when we have initiative, as we mentioned in one of the earlier units, initiative does tend to hold consistency with the volume. So you don't want to see low volume in terms of the metrics. And do note, you will most likely, on a really good reversal candle, you will see probably one of the highest daily volumes recorded within a couple of days, weeks, months. Now, in terms of time, time is quite important. You want to, like I said, it's ideal to have the strategy on a time-based rotation, simply because you can see the really aggressive auctioning in the opposite direction. Now, we said time is crucial because time will reflect whether we get some symmetry in terms of the rejection, and obviously if we have an engulfing candle, well then we expect continuation on that engulfing or outside candle within the next couple of time frames. So again, pay attention to time and do factor that into your analysis. In terms of delta, it'll be light in the initiative for obvious reasons. We will see dark patches obviously with absorption and reloading. Now note upward stars there next to absorption and reloading. I just want to really clarify the difference. Now, absorption, as I've utilized throughout this course, is simply where if a market's going higher and suddenly someone starts to sell it, but a buyer holds higher prices, he's simply absorbing the market at higher prices. We can also say it in terms of vice versa. Now, in terms of reloading, there's a slight difference between absorption and reloading. Okay, reloading technically comes from the price ladder or the depth of the market, and reloading simply means it's one order being reloaded. So on the ladder, you would see it say someone had a 100 lot contract, and as someone begins selling into that 100 lot contract or into that 100 lot bid, ultimately the buyer reloads it back up to 100 and constantly reloads it, getting a fill of ultimately their long position. So that's the main difference between reloading or absorption. In effect, they do mean similar things. They are very, very similar. Absorption, however, I'd say technically happens over potentially more than one price, okay, whereas reloading tends to signal out one price. Okay, in terms of then the cumulative delta, we will obviously see accumulation in terms of the initiative, and then obviously it will reverse as we get initiative in the opposite direction. In terms of the relative change, it will, we will see a relative change in price direction. That is the real key. It's the sudden shift as prices move up to a sudden shift of prices moving down, and that's the real nuance to the strategy. It's knowing that interaction between the buyers and sellers and seeing it being reflected in the relative change of price. Okay, in the next slide, we're going to finish off our template with the execution part of the template.